Hey everyone, Couch Investor back to another video for today. So in today's video, we're going to do a bit of a different type of video. I'm not going to talk about a specific company, even though I do want to show you some examples from a company like Apple and a company like Home Depot to show you how they have fared in the past, because obviously this is not the first bear market that these companies are going through, not the same industry. So you get a bit of both. We're also going to have a look at the S&P and the Nasdaq as well. I'm going to show you exactly what history tells us, some notes from JP Morgan Asset Management. So if you're interested in all of that, sit back and relax, hit that thumbs up button and maybe subscribe if you haven't. Would really appreciate that. Now, if you want to support me and this channel, maybe check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Make sure to check out all the other links in the pinned comment as well. And to quote Warren Buffett, be greedy when others are fearful and be fearful when others are greedy. Are people fearful today? I think they are. Now, let's start with some graphs. So I want to start off with the S&P 500 index and inflection point. Now, obviously, there's a lot of information here, so I'll try and keep it as simple as possible. But the information is pretty valuable. So they say here that in 2000, more specifically March 2000, this is the level the index was at, 1,527. At the end of September, we were closer to 3,500. Now, as for a PE ratio, a forward PE ratio, we can see that today we're now as cheap as in 2007. When it comes to dividend yield, well, that hasn't really moved that much over all these periods of times, from 1.3 to 1.9%. Then the 10-year treasury were now again much lower than back in 2000 and 2007, but we are a bit higher than 2020 and January 2022. Now, of course, if you look at the graph, you can also see all the declines, right? So March 2000 declined 49%. Then we went up 101% to reach that top again back in 2006, 2007. Then we had obviously the crash there, 57%. And then we went on a huge bull run for a decade that went up 401% to then decline 34%, to then go back up very fast, 114%. Right now, the S&P 500 is down 25%, give or take a couple of percentage points here and there. So if history tells us one thing, is that, well, while crashes can be very violent, long-term investors tend to do quite well if they stay invested. Now, a little comparison between value and growth. So here on the left, you can see value versus growth relative valuation. When you look at the relative forward PE ratio of value versus growth from 1997 to the present, you can see that, well, the long-term average was 0.72. Right now, this was September 30, we were 0.59. I would say that since then, the market has become a bit worse, so we might even be a bit lower than that. When you look at the current forward PE for value, we're now sitting at around 12x. Long-term average was 14x. As for growth, we're sitting currently just over 20, and the long-term average was also just above 20. Now, if you want, you can pause and look at this graph on the screen for the returns and valuations by sector. Obviously, lots of information, so just pause the video and maybe print screen or something like that if you want to use it for later. And the same goes for this one right here. So the factor performance, you have cyclical, high dividend, small cap, medium cap, etc. throughout the years. If you want to look at that, pause this video and look at it as long as you want. And now I would say probably the picture that tells a very good story, let's say. So this is the annual returns and intra-year declines, the S&P intra-year declines versus calendar year returns. So despite an average intra-year drop of 14%, annual returns were positive in 32 of 42 years. And this again is why staying invested in the market for as long as you can is much better than trying to time the market, maybe leave during a bear market and come back during a bull market. Stay invested, and as this picture shows, well, 32 out of 42, quite nice. And of course, last thing I want to show you here before we go and look at the Apple, Home Depot, and the Nasdaq graph. So bull versus bear markets. Bull markets on average tend to last longer than bear markets. So again, the point of staying invested is reinforced right here. And if you want to look at it longer, pause the video, print screen, do whatever you want with it. So I hope you found this helpful. Now let's go and look at a couple of extra graphs, Nasdaq, Apple, and Home Depot, and how they have fared in the past. So we're here on the Nasdaq 100 index. You can see that right now it's down 35%, maybe even a tiny bit more. We can see that back in 2020, the crash there, well, it dropped close to 30% as well. Back in 2018, we also had a, let's say, small-ish bear market pretty fast. That was down 20%. Now, of course, if you zoom out, you can see that those two bear markets, well, compared to the bull run it had, it's nothing. Then if we go even further in time, the financial crisis of 08-09, it dropped more than 50%. And then obviously the dot-com bubble, the worst, dropped 82%. But again, if we zoom out, then we can see that staying invested is obviously the best option. Now, of course, it's easier said than done. And I'm not going to lie, today, obviously looking at your portfolio, looking at the investment world, let's say it's not easy. Nobody said this is going to be easy, but for long-term success, if you have the time, if you have the patience to build up your portfolio for a long, long time, yes, then during those hard days is usually the best time to invest. And the same goes for Apple. Apple is down now 22%. So obviously compared to many, many other tech stocks out there, not that much. But just for the sake of the discussion, yes, they're now down 22% from their all-time highs. Back in 2020, they dropped 31%. Back in 2018, 35%. They even had a very, very bad run back in 2015. That dropped 30%. Back in 2012, dropped 42%. Then if we go back to the financial crisis, it first dropped 40%, made its way back up, and then it drops close to 60%. Of course, if you look at the price, it was at the bottom there in January 2009, just over $3. Right now, we're sitting at $138. But we can go even further in the past. Obviously, dot-com bubble. What happened there? Well, it dropped 82% to, well, 25 cents. And of course, a company like Apple is paying a dividend. So if you reinvested those dividends, well, it's safe to say your investment has been pretty good. Now let's have a look at Home Depot, completely different sector, but also a fairly strong company. So Home Depot is currently down around 35%. Back in 2020, it was down 41%. Late 2018, 22%, close to that. Then if we go obviously back to the financial crisis, it dropped 55%. But as you can see, back then it dropped to, let's say, $18. Right now it trades at $276. So again, during bear markets, pretty good opportunity to buy broken stocks, not broken companies. And during the dot-com bubble, it dropped 70%. To $19. So actually 08 was a bit worse for them than the dot-com bubble. So I'm doing this video obviously since we are in a deep bear market. Most growth stocks, actually all stocks, maybe besides energy oil company, are being thrown into the garbage with every other bad company out there. Doesn't really matter if your company is growing earnings, margins, revenue, etc. Everything goes down because the current macro environment, well, doesn't look great. Interest rates are going up. Let's see what the Fed does in their next meeting. Hopefully no 75 basis points, but hey, I'm not the one deciding. But overall, obviously, if you're looking for 1-year returns, then yes, what you do today will affect that. But if you're looking for 5, 10, or even more, then, well, whatever happens in the next coming months shouldn't really affect that decision. As long as you pick out great companies, strong companies with good management, 5, 10 years from now, unless, I don't know, aliens invade this planet, these companies will probably be much, much bigger, and the returns for your portfolio will be, as we've seen with the graph, well, much better than what you should get in the short term. Because in the short term, a lot of things can happen. In the longer term, usually if you've done the research, if you've done the work, and you invested in great companies with great management, well, the result is you get rewarded. And so I'll end with the same quote I started this video: be fearful when others are greedy, and be greedy when others are fearful. So, have you been greedy lately or fearful? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button, and I'll see you all in the next one. Bye bye.